Okay, great. Well, thank you for having me here. I guess the first question I ask everybody is to see how many people have actually seen any of my candlestick training presentations. That way I know how fast or slow to go on each chart. All right, looks like most have. All right. So with that, today we'll do how to do trend analysis and why to do trend analysis using candlesticks, which is much more effective when using candlesticks because we know the information that's built into each signal, which allows us to better analyze what's going on in investor sentiment in the trend. So why is trend analysis important? Obviously, whenever you're trading, at least you're putting your portfolio positioning in the right direction of the trend, which is very important whether you're day trading, swing trading, or even long-term investing. So anytime I look at a trend, the first thing I look at is the signals, the patterns. Where are we with stochastics? Are we overbought or oversold? And where are we compared to trend lines or moving averages, anything else that everybody else would be watching? So on my charts, you see that they're relatively simple. You've got the 20, 50, and 200-day simple moving averages. And the reason for that is every major money manager around the world uses those moving averages to make their decisions. The important one is going to be down here, the 8 exponential moving average, which we call the T-line. And the T-line basically is, we'll get to that, but it's very effective. So what signifies the markets? The Dow, the NASDAQ, the S&P 500. Everybody always asks, well, why use the Dow? There's only 30 stocks in there. Because it's usually a good representation of what the investor sentiment is out there, especially in the big money. And it doesn't matter how many charts you look at because candlestick analysis is visual and it's so quick. I can look at the Dow, the NASDAQ, and the S&P 500, and in a matter of 10 seconds, 3 or 4 seconds on each one, pretty much tell you what the market trend is doing. So obviously we have uptrends, and it becomes very apparent when you can see trend channels. We know the uptrend remains in progress as long as the channel stays in progress until they breach it. Or we can see if there's a downtrend. Again, there's your 200, the 50, and the 20-day simple moving averages, and then our T-line. Or we can see whether we're in a sideways market. Each one of these markets can be analyzed very simply by visual analysis and seeing what type of signals we have at the bottom or the top of at the resistance level or at the support level, and we can see much more clearly what's going on at those levels. So if we can see that there's a trend, at least we know that's the direction we should be investing. We also know there's different patterns, like a wave 1, wave 2, wave 3, or pennant formations, which make it very effective that where we can still see what type of signal occurred at the top of the pennant and what type of action we were getting at the bottom of the pennant formation. So whenever we see these pennant or wedge formations and we see a breakout, we know immediately, based upon this buy signal at the bottom of the wedge, you want to watch to see what type of signal we have when we get back up here at the top of the wedge and see if there's a new dynamic in the markets. So anytime we see something that looks sideways, we know there's been a change of investor sentiment when they breach the bottom of that trend channel. Now the advantage of candlestick signals is each day or each formation tells you what's going on in investor sentiment. Obviously a big bullish candle or a big candle tells you there's lots of pressure in that direction. Notice the pullback though. Notice what the nature was of each one of these signals. Little hammers, dojis, very indecisive. So that kind of gave us a good inclination that there hadn't been a reversal up here, but it was just a pullback. And again, staying above the T-line. Another trend. The pullback, very indecisive. And then what happens? They bring it right back up above the T-line and start moving it positive. I guess I probably should go into the T-line. Let me get through some of these charts. we may not know what's going on in this type of trend in the Dow. As you can see, it goes up, goes down, up, down, up, down. That makes for very difficult trading. But once we see that it's starting to breach the bottom of that trend channel, what can we start identifying? But there's probably a very slow curve, which we call the dumpling top, which is the opposite of the fry pan bottom, which is one of the major candlestick signals. And so we know we can't trade this because it's just too junky, but we know what the results are when you get back at the end of the fry pan bottom. You're going to have a very strong downtrend. So we might be sitting and going fishing, playing golf, playing with a dog, whatever, for months. But then when it breaks down, we can make a lot of money in a very short period of time. So we can see exactly where the support and resistance levels are based upon what type of signals we're seeing at those levels and where we are when it comes to stochastics. So this was kind of telling us, this was a while back in the markets where we had a nice steady uptrend. And what happened every time it came back down to the bottom of this trend channel? We could see there was another buy signal. Well, then there was one day we woke up and there was that doji, and we know the simple rule of the doji that the price is, or the trend is usually going to move in the direction of how they open after a doji. Well, we wake up the next morning when it's sitting right here on the support level and the pre-market futures are showing that the Dow is going to open up down 140 points. That gave us immediate inclination that we want to be closing out any long positions that are looking iffy and start going short. At the same time, when that steady uptrend was going on, we could see there was a very slow, choppy uptrend in the NASDAQ. And one of the criteria for identifying whether there's been a reversal in a trend is the fact that if you see an up day in the Dow and a down day in the NASDAQ or vice versa, that pretty much tells you the trend is still in progress. They're just shifting money from sector to sector. Now you get up back at the top of the trend on the same day that the Dow was at the bottom of the trend breaking down. We'd already had a bearish engulfing signal telling us they weren't going through the top and gapping down. That was a good indication that everybody was bailing out of the market. It was time to be out of the long positions and going short. There's some very simple analysis when you're looking at a trend. When they broke the 50, a support level, came down, we started seeing buy signals. What usually happens when they break a support level? They'll come back up and test it to see if it's going to act as resistance. It did the first time. Then notice what happened. A bullish harami and bullish confirmation. This time they went through. What happens when a resistance level is usually breached? They'll come back and test it to see if it's going to act as support. In this case, we had a bullish harami, which basically told us the selling had stopped. We could be aggressively buying on positive trading the next day, knowing that the uptrend was still in progress. That was on the Dow, the NASDAQ, same scenario. Came up. Notice once we got up here to the 50, we had hanging man, shooting star, hanging man, bearish confirmation. Then notice what happened when they came back to the 20. Lots of tails down here. My stochastics, Gary, are 12.33. That's nothing set in stone. I'm a swing trader. So for the last 40 years ago at some point, I spent an evening saying, all right, if the stochastics are going to confirm with a trend, what stochastics equate to when the bottom hit and when the top hit? And 12.33 for me has worked very well through the years. So the nice thing about candlestick signals is we can tell exactly what's happening at support and resistance levels. The NASDAQ reversing becomes much more obvious. You have a downtrend. Every time it came up to the 50, we had a sell signal, bearish engulfing signal, evening star signal. That pretty much told us our downtrend was still in progress. Same scenario here. Failure right at the 50. So because candlestick signals are the graphic depiction of what's going on in an investor sentiment, there's a potential reversal signal. And I say potential reversal signal. The T-line is the 8 exponential moving average. We call it the T-line because it's a trigger line. If we see a candlestick sell signal and a close below the T-line, we can stay short until we see a candlestick buy signal and a close back up above the T-line. Same corollary. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. So you have to have that combination. You can see we've had buy signals occurring from time to time in this downtrend, but it never confirmed above the T-line. So would we be ready to go cover short positions here? Not necessarily, because we're not up above the T-line. However, a few days later, what did we have? A bullish engulfing signal and a close above the T-line. That was the time to start covering the short positions. So was this a reversal signal? No. This was, and when you combine it that there was some buying starting in this area, just makes it that much more visually clear that was what was happening in investor sentiment. The buying was starting down here. So again, the T-line is very simple. If you see a candlestick buy signal and a close above the T-line, you can be buying and holding until you see a candlestick sell signal and a close back below the T-line. Now, I used to make good money just following the candlesticks, but when we applied the T-line to it, kept me in positions that I should be kept in without having to worry about getting whipsawed with what might have been a reversal signal. Now, the T-line, again, is these moving averages act like magnets because everybody and their brother has these on their charts, and the major money managers use these to make decisions about what they're going to do with their portfolio. So they act like magnets because if a price is moving back to a moving average, more than likely institutions aren't going to buy it until they see whether support's there. The T-line works very effectively, but nobody has the T-line on their charts. So the functionality of a T-line is more like a Fibonacci number. It's a natural support and resistance level. So when you combine the process of the graphics of human nature and the candlestick signals and use the T-line, which is kind of a Fibonacci natural support and resistance level, when you add those two together, you've got a very powerful combination of what goes on in price movements. So anytime we see a buy signal, we know we can hold until we see that sell signal and a close below the T-line. So we also, I've seen in the past where they advertise using trend channels. Well, it's much more effective doing a trend channel when you use candlestick signals because you can see exactly what's happening at the support and resistance level. So down here at the bottom of this trend channel, we see a morning star signal, a close above the T-line. Where do you? And our stochastics are down here in the oversold area. Just logic from the Japanese rice traders say if you see a candlestick buy signal in the oversold area, the probabilities are pretty high that you're now in a reversal to the upside. Same scenario, if you see a candlestick sell signal in the overbought condition, the probabilities are pretty good that they're going to take it back down. Then if you add other elements that everybody else is watching, like a trend channel, it just makes the probabilities of taking profits up that much more likely and getting ready to go short. So anytime we can draw a trend channel, we can see what's happening at those important technical levels using the candlestick signals. So anytime I'm trading and I want to know whether my swing trades should be long or short, if I can see there's a trend channel, I know I can be buying heavily here. And there's a caveat to the T-line, which is you can buy and hold until you see a candlestick sell signal and close below the T-line, with the caveat that the further away you move from the T-line, the higher the probability it's going to come back and test it. So if I'm up here with where would be a prospective resistance level, and I see the bearish Harami and it opens lower the next day confirming, I'm taking profits because where's my likely target going to be? Probably back here to test the T-line. What's my worst case scenario? It comes back here and bounces back up, doing what we call a J-hook pattern. I can always buy back in. But the signals and patterns pretty much tell you where the investor sentiment has changed. So once it gets up to this level and you can start going short, where's your next target? back to the bottom of the trend channel, and there's our big morning star signal once again. And notice where it actually bounced off. The doji day in between bounced right smack dab off the 200-day moving average. So we knew with the stochastics in the oversold area, a doji that hit the 200, if it opened positive the next day, we want to be buying aggressively. What this does for investors is knowing the simple rules of the candlestick signals, which are not many, that if it opens positive the next day after a doji, it's going positive, and if we already can evaluate it's in the oversold area and bounced off a support level, we're buying right here instead of here, here, or here. We're taking advantage of everybody else's buys. Now, the other main benefit of candlestick signals is we know what what human nature usually does based upon what happens after a candlestick signal, which means the probabilities on a positive open is that we're probably heading higher, which also helps with, through the last 40 some odd years that I've been trading, you can hear every money manager tell you to cut your losses short and let your profits run. The only problem is they never tell you how to cut your losses short and let your profits run. So if it opens positive, where do we not want to see it open or close? Back below this level. We're right back out of the trade. So I tell people, you don't have to be a sophisticated investor or technical analyst. All you have to do is be able to see, and you can trade candlesticks very well. And I kind of illustrate that with the old couple that are getting ready for bed, and she's kind of standing there in front of the mirror naked, and she said, look at me. My face is wrinkly, my arms are skinny, my butt's scrawny, my legs are spindly. You should turn around to her husband. Anything you can say about my body that would make me feel good? He goes, well, your eyesight's still pretty good. So as long as you can see, you can take advantage of what goes on in human nature in candlestick charts. Anytime I see a trend channel developing, I know to start watching at those levels, especially in the oversold area, of where I should start seeing reversal signals. And when I do, again, there's our candlestick buy signal to close above the T-line. What's our next target? Back up to the top of the trend channel. So it allows us to see exactly what's happening at support and resistance levels and what to be doing once we hit a resistance level that's not as resistance anymore. It also allows us to look for where everybody's watching to see if there's a resistance level. And notice what was happening here. Notice how the T-line kept pushing up right through this resistance level. That's called a T-line crunch. What stocks do you pick after analyzing the market? Brad, my first analysis every day is which way is the market going? If we're bullish, obviously I'm doing my scans for bullish charts. If the market's bearish, obviously short positions. And the scanning technique for candlesticks is very simple. Once you put your formulas in, all you have to do is update them each day, and it will show you which signals or patterns that you're looking for. So I tell people that if you're inexperienced with candlesticks, it may take you 20 minutes each day to find the best trades for the next day, or the best swing trades, or whatever time frame you're investing. Now, candlestick charts also work just as effectively on a 1-minute chart, 10-minute chart, 30-minute chart as they do on a weekly, daily, or monthly chart. If you go back to the very basic analysis, or I want to say definition of a candlestick chart, it's merely the graphic depiction of what's going on in investor sentiment during a particular time frame. So it works just as well on a 1-minute chart. I used to trade the E-minis off the 1-minute, 3-minute, 10-minute combination. Right now I usually trade futures like soybeans, cattle, the dollar, that type of thing off the 10-minute chart. And my swing trades in stocks are usually off the daily charts. So they all work just as effectively as each other. So when I can see there's a Morningstar type signal bouncing up off the T-line right here at the resistance level, that tells me I've got a good probability that the resistance level isn't acting as resistance anymore. Same scenario here. We can see where the channel was. This is what we call a doji sandwich. A big down day, then a doji. Remember, a doji represents indecision between the bulls and the bears. And then we know the simple rule of the doji. It's going to move in the direction how they open it after a doji. So when we see them opening it lower, we can be shorting because we know that the magnitude of this candle and the magnitude of this candle will usually be the same, thus the doji sandwiched in between. And we know what the after effects of a doji sandwich will be, usually more downside. So we also can use the candlestick signals based upon stochastics and the power of our signal of projecting targets. So here's what we call our best friend signal. A doji in the oversold area followed by a gap up. That's your best friend for two reasons. One, because it will give you an extremely high probability that you're in an uptrend. And two, the uptrend will usually be very strong. So if you break down what happens in investor sentiment, that you have some indecision down here, then they gap it in this direction. That told you they made up their decision, and when they gapped it up, they made up that decision with a lot of force behind it, which will usually continue the uptrend. So this is why we use the analysis. Notice right about in here, it broke out with a gap up. Up here in the overbought condition, notice what was starting to happen. We were starting to see some sell signals, so we're definitely out of the position here. If we're out of the position here, we can wait to see whether this is a J-hook pattern, which we'll get into, or whether it's closed back below here. But just starts telling you when the investor sentiment is starting to go the opposite direction. Blue was another one where when we see it hit the resistance level, we can start going short. Where's our next logical target? Probably back to the bottom of the trend channel. Same scenario. If we can see there's a downtrend and we've got a sell signal, our next likely target is the bottom of that trend channel. The T-line is the 8 exponential moving average. And it's just a very simple, not simple, but kind of a Fibonacci number or value that tells you that if you're above it, you're in an uptrend. If you're below it, if you see a candlestick sell signal and close below it, you're going to be in a downtrend with a high degree of probability. Again, so whenever we see the markets hit a level, and then notice what happened when it got up here, started getting very indecisive, that gap down told us we're back in a downtrend, probably down here, so we're shorting positions. It just gives us a much more clear format or roadmap to tell us which direction should we be heading. I'll do the same thing on soybeans. Again, if I'm buying here, this could be a 1-minute chart, it could be a 10-minute chart, or it could be a daily chart. But as long as it doesn't do a sell signal and a close below the T-line, I just stay long in this uptrend. This is what we call the fry pan bottom. Notice you couldn't trade this one way or the other if you wanted to. But notice where it broke out, right about here and right about the 200. And what are our expectations? There's about 5 or 6 candlestick patterns that tell you with a high degree of probability that not only are you going to be in an uptrend, but you're going to be in a very strong uptrend. This basically is human nature, building back up, and then bam, they take it up hard. Now, usually when we go through our trainings, we show where do you want to buy on a buy signal. Usually when the stochastics are in the oversold area. What are we looking for when we're in an overbought area? We're looking for sell signals. However, when you're coming out of a pattern, you're usually going to be in an overbought area. So that's kind of a confirmation that this is where the exuberant buying is going to start coming in and you can make big profits. If we can analyze, and we call this observe the obvious. The obvious is we're in a downtrend. It reversed. And notice where it failed, right smack dab on the 50, closed back below the T-line. We can stay short until we see the next buy signal. The evening star signal, this was the trading the lean hogs off a chart. There's our evening star signal and a close below the T-line, stochastics in the overbought area. The probabilities are extremely strong that you're going to start heading down. Dow trend was up, And how do you see the reversals? Again, there's an evening star signal that moved away from the T line. There's a morning star signal that bounced right off the 200-day moving average. There was your uptrend until they closed it below the T line. So what's the market telling us right now? Well, we can see all summer we moved absolutely sideways. Just nothing going on. For the last month, we've moved absolutely sideways. Now, what's that tell us as far as what should we be doing? Well, obviously, if we can analyze that each day there's an up day, there's a down day, there's an up day, a down day. That's telling us we shouldn't be exuberantly long, we shouldn't be exuberantly short. We may have long positions and short positions on. Now, the other day, yesterday, for example, we had a big up day, which kind of created a kicker type signal to the upside. And notice where it hit its high, up above the 50, but closed back below the 50, which is still in this trend channel. So our analysis was, all right, we might be breaking out, but we weren't confirmed yet. We needed that confirmation. And the reason we needed the confirmation was, look what's happened over the last month. Up, down, up, down. I mean, this was investor sentiment. So we definitely needed to see bullish confirmation today to tell us that the bulls had taken control, but here's today's trading. Same scenario on the NASDAQ. We had a nice slow curve. It did a kicker signal, kind of closed moderately. So even though it was up strong, you could see what happened after it opened. It was not really decisive, but it gave the inclination that we could be breaking out to the upside. Then today's trading did this. And the reason we weren't jumping in full steam is because look what's happened over the last month. Up, down, up, down, up, down. We needed to see some confirmation. Let's see. There are other closes below the T-line in a chart. How did you not know? If it closes below the T-line very indecisively, I'll give it one more day. Because a lot of times when you see a close below the T-line, not on this chart, but if you see a close just below the T-line and it's doing it indecisively, you got to still consider that the trend was up and the only time they closed it below the T-line was indecisive. My criteria is it needs to open positive and trade positive the next day to stay in it. The trigger is the elections. We don't know. I mean, anytime markets go up or down, there's always some reason for it. So what we're more concerned about is what's happening in investor sentiment. Now, patterns and candlesticks work very effectively because they are the accumulation of investor sentiment. For example, we've been long REN ever since it broke out here. Now we were out here because it closed below the T-line. But then there's our what we call a left-right combo. A left-right combo is a doji, which is day of indecision, and then the roundhouse right, which is a bullish engulfing signal. We're back in this trade. Now, before candlesticks came along, I was the worst investor in the world. I was even a stockbroker for 8 years, and I got out of the business because I discovered that the brokerage firms had no more idea about what made a price move up or down than anybody else. When candlesticks came along, it just made sense. So I went from being the worst investor in the world to where I'm now consistently taking money out of the market every month, because every time I know I see a buy signal and confirming, I know I'm going to be in the right direction. If I see a pattern like this, I'm buying right in here because I know one or two things are going to happen. One, that fry pan bottom breakout is usually going to be a very strong move. Or two, if it fizzles, I'm right back out of the trade with a very small loss and go on to something else or wait for the cup and handle setup. So that's what we were seeing in Apple today. This is the chart on Apple over the last few weeks. Nice fry pan bottom. And look where it's trading today when the general market is down 165 points. We know what a J-hook pattern is. That's a strong price move followed by indecisive pullback and starting back up, and does a J hook back to the upside. We're expecting this pattern because this is what we call the classic pattern. There's our fry pan bottom. What do we expect coming out of a fry pan bottom? A very strong price move. What do we expect for a J hook pattern? A very strong price move, and then the next move. We know that this wave right here will be the same magnitude as this wave right here. So we buy the patterns because there's two benefits. One, it's usually going to produce high probability results and high profit results, and it doesn't really matter what the market is doing. This is the same chart. Notice today it's still trading higher when the market's down 165 points. So again, all this is what the Japanese rice traders have illustrated to us, that prices move in patterns based upon the recurring perspectives of human nature. And I always tell people, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick charts are merely the graphic depiction of what's going on in human nature. So with that, we try to utilize the information built into candlestick signals. You don't have to be you don't have to overanalyze candlestick charts. It's very simple. It's just no formulas, price percentage, no price percentage moves, just common sense visual analysis. So when I tell people you don't have to overanalyze candlesticks, it's like the lady that brings her parakeet into the vet, lays it down on the table, and the vet says, "Well, ma'am, I'm sorry, but it looks like your parakeet's dead." She goes, "Oh, no. Are you sure? He's been my best friend for years. Is there something you can do?" And he goes, "All right." So he goes out to the back of his clinic, brings in a cat, lays the cat next to the parakeet. The cat kind of sniffs the bird, looks up at the vet, kind of shakes his head, says, "Ma'am, I'm sorry, but your parakeet's dead." He goes, "Oh, are you sure? He's been such a good friend. I'd hate this. Is there anything?" He goes, "All right." So he goes out the back of his clinic and brings in a great big Labrador retriever, comes bounding in, puts his paws up on the table, sniffs the bird, looks up at the vet, kind of shakes his head. And she goes, "Ma'am," he goes, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh." So they go out to the front desk, and he says, "Well, that'll be $250. She goes, "You're charging me $250 just to tell me my parakeet's dead?" And he goes, "No, ma'am, I would have done that for 18 bucks. Then you wanted a CAT scan and a lab report after that. So I tell people you don't have to overanalyze candlesticks. It's just all graphics. Whoops, that's not what I want to do. Just graphics of what's going on in human nature. And it's based upon the most basic of all consistent indicators in the world, and that's human emotions. So that's about all I got. I guess Pat has a special for everybody. We've got 90 minutes of how to use candlestick charts to analyze the trends as well as price trends for let's see, I'm trying to put the link in here. Let's see, I just put it in over there on the right. That we've got 90 minutes of where you can use the common sense that's built into candlestick charts to analyze what the market trends are doing or what any price trend is doing. I think it's usually like a $147 video. She's got it on there for $17. So click on that link, and that'll give you all the details. So with that, are there any questions that I can answer for people? None? All right, well, I want to thank everybody for allowing me to be here today. Renee, thank you very much. The link didn't work. Well, that's a fine howdy-do. Let's see, Renee, do you happen to have the link?
It looks like you had sent it as a reply to someone's question. Let's see if I can copy it and send it out to everyone.
Work for some. Okay, try it. Keep trying it. Okay, worked. As I say, for three cups of Starbucks coffee, the 90 minutes will give you lots of insights onto how to use, or at least be able to analyze which direction trends are going with much greater accuracy. Oh, you have to copy and paste it? All right, great. All right, any other questions that I can help with? If not, Renee, thank you very much for the invite today. Guess we went kind of fast. Please go back to a chart and show why you didn't sell on other closes below the T line. What is the difference? Ooh, Rebecca, let me go back and see. Again, a lot of times the longer a trend, now in this case, we started taking profits here because we had a bearish engulfing. We're in the overbought area. We were suspecting it's going to come back to the T line. We're buying back here because there's again our doji gap up best friend. And what's the doji gap up best friend telling us? One, they're not going to close below the T line, and two, we're probably starting wave 3 of our wave 1, wave 2, wave 3 J-hook pattern. Let me go back to see if I can find. That's the same one. And those are the here's a case where, yeah, we did close out here. We bought back here. Now, it used to be, if I closed something out, I wouldn't get back in because they weren't going to trick me in by getting me out and then getting me back in and then taking some more of my profits. But now I know what type of patterns happen in human nature. So I know when to be buying or selling. I know when to be buying, selling, when to be buying, when to be selling, and when to be buying again. Trying to find a uptrend that I guess we've got a bunch of that. Here's a case where notice we didn't close back below the T line here. We did right here. So if we'd been trading the YMs, but notice how long this trend had been and what the I guess the analysis was. That we were definitely above the T line, and we had 1 day below the T line in an uptrend. So my criteria the next day would be it needs to open and trade higher. If it opened and started trading lower, that would tell me they were confirming my bearish engulfing signal and staying below the T line. Now, here's a case where same scenario. Close below the T line. What do I need to see to stay in the trend? I need to see them open it and trade positive. The fact that they opened it and started trading lower told me there's now a change of investor sentiment. Close out the position. Are we forming a dumpling top in the SPX? Yes. It's starting to roll over very slowly. I don't have the SPX on here. But the SPX you can see is slowly rolling over, whereas the Dow you can see is definitely trading sideways. Okay, any other questions? The one thing about candlesticks is, like anything on Wall Street, if it doesn't work, it doesn't stay around. Candlestick signals have been around for 400 years. The Japanese race traders that used it didn't become wealthy in Japan. They became legendarily wealthy. They were the financial powerhouse for centuries in Japan, and they did it off the most basic of commodities in the world, which was rice. So again, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So with that, thank you everybody for being here. Renee, thank you for the invite. Hopefully we'll see everybody in the chat rooms.